Good afternoon, everyone. This is Taylor Hudson, joined by Hugh McNaughton for Sprague's Market Brief on May 7th, 2012. We've had quite an event the last 4 or 5 days. Actually, right around coming back from the Aerie show last week, we had the market move way off, and it's almost deja vu. We've spoken about it, Hugh, on this program before about the fact that last year this time we had a dramatic sell-off and the reasons behind it. We're getting a lot of calls from people and just inspiring a lot of look-back discussion. So we thought we would start there. What we have here is a chart for everybody of nearby heating oil, basically from January of 2011 right through to roughly June of 2011. And Hugh, if you wouldn't mind being our tour guide, you could take it away. And one thing we learned at Aerie, everybody wants you to speak up on the microphone, so you're going to do that.
Okay, Taylor. I'll be trying to be more audible here. We did a presentation like this a couple of months ago, essentially looking to see if we could see any similarities between last year's, rally and then decline with this year. But of course now it's actually coming into place, right? Last year, looking at this 2011 here chart, from the very beginning of the year through to its peak. Actually, a really rather remarkable straight line, although, yeah, a few dips and whatnots. But up to that April 10 high of 332, which will have some significance, as you'll see in the next chart. The reasons for it, looking back over that 4-month rally there, most of it was was supply related. We had the whole Arab Spring. We had the outbreak of the Libyan civil war. Nigeria looked very unstable for a while. All of which, as normal, puts the fear of God into the petroleum trading community. The dollar, the prices were helped by a steady and very gradual weakening of the dollar during that time frame, moving, I think, as I recall, all the way up from the high 130s up to about 150. Ironically, in terms of what's happened this year, the European outlook looked better than ours. There was towards the end of the rally, the increasing concern by the IMF and other government entities about the economic impact of high prices. And remember, last year, this time, the U.S. was not the leader at all. China was still bubbling along, but it looked more like Europe was in a better shape than we were. Then also towards the end of the period, Goldman Sachs, among others, came out with warnings that the petroleum as a commodity was overvalued, or in fact all the commodities were overvalued. And lastly, playing a role in all of this was a very solid technical outlook all these 4 months, suggesting really that buying the dip mentality was the way to go. So there you are.
You mentioned the technical outlook here, Hugh. It's kind of interesting looking back at last year. We had the market moving up and never really breaking down through its 18-day moving average at all. Over a 5-month period, the 40-day moving average wasn't even close to where the market was trading. And it wasn't until right there in the beginning of May where we had a 10+ cent move and the market got below the 18-day, quickly went to the 40, and then obviously on I think it was May 5th here, really broke down below the 40-day moving average that we had any technical reason to be bearish at all. So you're right. We only had bullish technical news going for us for quite some time.
Same beginning year rally, this time on a relatively strong U.S. economic outlook. We were coming off, you recall, that fourth quarter GDP of 3.1%. Expectations were that strength, that growth would continue on into 2012. relatively unabated. It looked like finally Europe was coming to grips with their debt issue. At sometime, I think it was in February or so, Greece, the whole Greece aid package seemed to have been resolved, and a couple of the other PIGS, PIIGS, of course, so we don't call our European friends PIGS, appear to be out of the worst of their troubles, particularly Ireland and Spain. Portugal, a little bit of a basket case, but even so, not so bad. Basically throughout the period, the Iranian situation got worse and worse until finally we had that Strait of Hormuz threat. That was in late February, I think about February 24th, and it didn't go away, but it did hang on, and did a little bit of the pressure, immediate pressure was off the market. Of course, then recently, the European debt issues have really reasserted themselves. Europe has gone, no question, into a recession. China started to slow down, or has started to slow down. We, of course, have started to slow down. And now the whole economic issue is very much more serious and more in doubt than it has been. The geopolitical issue has gone away a little bit, with Iran having discussions with the 5+1, with the West anyway, on their nuclear enrichment program, and look like they might just be prepared to make some concessions. And finally, Saudi Arabia, God bless them, they have really come out, and they are, I'm sure it's in their long-term interest, but making an effort to keep a high output going. The bottom line, Taylor, I think between the two of them, I'd be interested if you see anything different, is that the same two factors prevail: geopolitics, or supply disruption, and economics, demand destruction. There are different ones this year than they were last year, but it's just basically the same tug of war between those two and behind what we're seeing today.
Well, it'll be interesting to see if this last year, after the market sold off in early May, that was sort of the floor for the market for the entire rest of the summer. If we remember back, we were at 276 or something like that on May 6th of last year, and that support, or that low, held for the rest of the summer. Right now, we're trading, everybody can see on this chart here, we're trading just above 295, right around 298-ish, and that happens to be a low that we set back in January. The next big support level is 288, set back in December. But if indeed this route is over for now, it'll be interesting to see whether or not this floor holds for the rest of the summer. I think when people ask, well, do you think we're going to go down more or not? Certainly, anything can happen, but it seems likely to me that the Iranian issue probably isn't over yet, and we're still going to see some saber rattling on that front at some point. So going back to last year, like you said, 5 months worth of rally that was worth about 75 cents in a matter of 5 or 6 days. We erased almost half of that, or a little more than half of that rally. And this year, from January until top of February there, we went up about 30 cents, 32 cents. And in the course of 5 or 6 days of trading, we've erased almost half of that. So certainly the market has come off quite a bit recently, and in the same proportion, if you will, that it did last year. One thing I wanted to talk about after the current price charts was an update a little bit on price protection. So if we go here to the fourth slide and we look at the Octa-April heat curve, again, this doesn't have any differentials in it at all. It's simply the heating degree day weighted average of NYMEX pricing for next season. And we introduced this slide a few weeks ago to folks when we talked about programs. Basically, this brown line here on the bottom that really went from a high at 285 all the way up to 340-ish, basically was last year what you were looking at if you were going to buy wet barrels, let's say, and send out a program. This was the base cost that our differential would have been added to. And in red, same time period, but looking at 2012 to 2013 heating season. And we noted in our last presentation when these crossed, we couldn't believe the fact that if you put out a program back in March, it was likely to be at the same price level you offered last year, same time. I think we said that was simply because we'd been above last year for so long. And then we really diverged in the month of April and here in early May, quite a bit lower. But it come to find out that essentially right now, if you were going to offer price programs for 2012 into 2013, you're doing it on a NYMEX cost basis that's roughly the same as it was same time last year, just under 305. We saw a lot of programs last year out in the 379, 389, 399 area, and that's about right for the industry on average. If they start with 305, they have 10-cent basis cost, 315, let's call it a 70-cent margin on average. We're at 385-ish to $4. So people always want to know, are we seeing a lot of folks doing programs yet? Not so much, but we have, with this dip, definitely seen an acceleration of tire kicking. Folks interested in where pricing is for next year, and the folks that had already started are continuing to buy on this dip. Two small issues that are worthwhile talking about, and that is every time we get to the spring and folks have price protection customers that were on budgets, we look at what would happen if they re-enrolled that budget customer today. And given the fact that forward pricing is roughly where it was last year, and due to the fact that we had a warm winter, a lot of customers probably have leftover credit balances for gallons that they didn't use, on top of the fact that downside premiums for next year are running, I think, a little cheaper than they were this time last year, in the order of, let's say, 25 to 27 cents instead of 30 cents to 35 cents. The combination of those two things actually allows a dealer to potentially put out a budget program that has a payment associated with it a little less than last year, and that's always good for renewals. We could certainly talk to you about those things anytime you'd like. So with that, I want to wrap it up. And as always, we encourage your feedback and let us know what you want us to talk about or what we can do better. Thanks, Hugh.
You bet, Taylor. And everybody have a good evening or a good morning whenever we get this when we ever get this program out.